Hi, I'm Mike Bernick for Money and Markets Extra. The deflation versus inflation debate has really heated up this year as global economic data has taken a turn for the worse. And that's sparking fears of a deflationary spiral, which we've experienced a few times since the financial crisis. Meanwhile, 20 global central banks are responding with coordinated interest rate cuts so far this year, covering over 50% of the world's population. And of course, this extraordinary easing has inflationary implications down the road. So here today with me to discuss this hot topic, a professional money manager with decades of experience, both on and off Wall Street. Bill Hall, Managing Director of Plimsoll Mark Capital and a special contributor to Money and Markets. Welcome back, Bill. It's good to speak with you again.
Mike, it's great to be here. Thanks for having me.
Absolutely, and you put together a great slideshow for us today, as always. So let's start with the very first slide and see where we are year to date. A few things jump out at you here in this slide. Number one, global stocks are doing a lot better than U.S. stocks this year, which is a bit of a change of tune.
Well, that's because the global central banks are following our lead, Mike. The Fed led the way with QE, and now we have European Central Bank playing its own version of QE out in Europe. And Japan, as you know, also was late to the party last year, and they have their own version of QE going. So what's happening is the rest of the world's financial markets are just catching up with where the U.S. was a couple of years ago.
Yeah, or perhaps catching down. So in this next slide, you're framing the key argument for this year. It's going to be a tug of war between the forces of inflation and deflation. Is that right?
That's what I think, Mike, and you set it up perfectly at the beginning. But what I'm going to tell you is I believe deflation, unfortunately, is winning out. Deflation is the primary economic force in the world right now. It's pushing all economies towards recession. And it's something we have to be really worried about. I see no signs of inflation. I see lots of money printing, but I see no signs of inflation because there is no velocity, meaning the money is not moving through the economy. We've talked about that in the past, and to get inflation, you have to have velocity.
So what's going on in global markets right now that are driving these forces at work? In this next slide, you're saying perhaps it's too much debt. That debt overhang since the financial crisis is still with us.
That's right. If you look at this slide, what you see is not only have we have more debt than we had as we entered the financial crisis. I thought we were supposed to be paying this stuff down, but instead what we've done is we've just compounded the issue by moving debt from the private sector to the public sector. So the governments around the world have become more indebted as they've taken on all of this toxic waste in terms of debt that just existed around the world. And we're slowly working our way through it, but we haven't gotten there yet.
Indeed, it is a worrying sign right there. Now, turning to the stock markets, we see here in this chart, the S&P 500, we're 6 years into a new bull market since the low in 2009. Stocks are up over 200% from those lows, yet valuations are starting to look a little bit stretched at this point, aren't they?
Well, that's what really has me worried right now, Mike, is this level of valuation. I mean, we've been here for a while in the U.S. We haven't had over a 10% correction in about 3.5 years right now. And we've got to do something to get these valuations under control because there just isn't any earnings growth out there. In other words, deflation is winning out. You're seeing flat GDP numbers. And with these deflationary forces, we just can't have multiples continue to drift higher, because if we have multiples drift higher, we're just setting ourselves up for a bigger problem down the road.
That's right, and you can see that clearly here in this next slide you prepared for us. While the price in terms of stock prices have continued to go up, the earnings are not. They're rolling over, and we're going to see the first quarter of negative earnings results here in quite a while for the S&P this quarter.
That's right. Can you believe that? That we're talking about raising rates. The Fed is talking about raising rates in a period where we have negative earnings growth. That's just not going to happen, Mike. We're not going to see any rate increases because the economy can't stand it. We may not even be able to get a GDP print of in excess of 1% tomorrow when that number is announced. So corporate earnings are rolling over here in the U.S. because of the strong dollar. GDP is really soft because of deflation. There's just no way we're going to have a rate increase anytime soon.
And here in this next slide, another surprise that you accurately predicted last year, that Treasury bond yields would remain low, lower than most people thought possible. How low do you think they can go here in this environment?
I don't know how much lower they can go, but I'm going to be here on record telling you right now that they're going lower than where they are today. And if you're looking for a trade, if you want to trade, this is not a long-term investment strategy, but if you want a trade, buy the 30-year Treasury ETF, because as interest rates drift lower, what you're going to do is you're going to get price appreciation on that ETF because rates are going to go lower before they go higher.
All right, well, let's sew this all back to the investment market and where you should look for the best opportunities right now. And on this last slide, you've got several big investment themes that investors should consider playing. 4 areas that you like and 2 areas to avoid. Why don't you run through them for us?
Well, Mike, what I'll tell you is the first one that I really like, especially in this environment where we have very high valuations, is I like to buy quality. When valuation levels are higher, there's a lot of uncertainty. You want to buy quality and you want to buy dividend payers because you want cash on cash returns. You want that certainty of having money in your pocket. The second thing you want to do is, because we're in a strong dollar environment, is you want to stress U.S. mid-cap. You want U.S. companies that are trading with U.S. companies, and hopefully fast-growing U.S. companies that are trading with other fast-growing companies, because then they're immune from the effects from the dollar. Number 3 is there's lots of value over in Europe. Europe has, as you know, is significantly underperformed. And as I said before, the ECB is pumping tons of money into their economy. So what I think you want to do there is that you want to buy hedged European value stocks, but they've got to be hedged, because as a U.S. investor, if you're not hedged and the dollar gets stronger, you're going to give back all those gains. Number 4, and I already gave that to you earlier. This is a trade. It's not an investment opportunity. It's buy the 30-year Treasury ETF, because rates are going to go lower from here.
Okay, TLT is the symbol on that, right?
That's right. Would you want to give the people the symbol one more time?
Yeah, TLT. That's the 30-year Treasury bond ETF, right?
That's correct. That's what you want to buy. You want to own that, because as interest rates come down, you're going to get a total return pop out of that ETF.
Makes sense. Now, what areas would you avoid right now?
I would avoid emerging markets. Even though they've had a great run so far this year, I think that they're going to run out of steam. I think things are going to get uncertain. And if you're in a broad emerging market ETF, you've got to be very careful. The only place that I see opportunity in the emerging markets is in Asia. And then the final place to avoid in terms of emerging markets is, I think you want to avoid low quality and cyclical. That's just the opposite of my point number 1, where you want to buy high quality and growth, but you want to stay away from low quality investments in this environment.
Well, Bill, thanks for those key areas to watch for both opportunities and to avoid some trouble spots. And thanks again for being with us today. You'll have to come back again real soon.
Thank you so much, Mike. I always enjoy talking with you.
For Money and Markets, I'm Mike Bernick. Good investing.